Hello, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as you know I like to call it, another episode of As the Housing Market Turns. Today is Friday, March 22nd. Hope everyone's having a great day. Got some interesting news to talk about today. We're going to review, I guess you could say, the top news of the week, which is, of course, the Fed declined to raise any rates in the next little bit. We've got existing home sales published by NAR, and I've got something called U.S. housing hits a brick wall. So let's start talking about what was part of big news this week, which was the Fed. And the Fed had their meeting this week and chose not to raise rates, which was just great for home buyers. It also stated it would not raise rates for the remainder of 2019 and actually deferred raising rates until 2020, where it suggested they may raise the rate maybe one time in 2020. So if you're taking a look at this is probably good news for home buyers, and obviously it's going to hold down mortgage rates, which is great. This of course is subject to change. Nothing is carved in stone, but the way things are going looks like they're probably going to stick with this policy. And this really is kind of a sign the Fed is actually becoming concerned about the future, and maybe things are not as great as they would like to believe, like GDP and global economic growth and stuff like that. They also cut their economic growth outlook for 2019 as well. So there's some, I guess, realization that the market isn't as wonderful as we all thought. Obviously, there's downturn in economic signals over the past few months, probably changed the Fed's thinking, along with a lot of pressure coming from the president, other people as well too. So what does all this mean? Well, of course, mortgage rates will remain steady, but actually also dropped the other day, which is great. They've been lower for a little while now over the past couple of months to try to stimulate growth and having buyers come back in the marketplace. And the Fed also stated that they would be getting back into the bond market, which apparently can take, if they do that, then rates can actually get a bit lower as time goes on. And again, I'm not a financial analyst. I'm just sort of restating what's been stated in some of these articles here. Now, obviously, mortgage demand has been slowly rising. It rose 1.6% last week. But however, the gains came from the refinance volume. Purchase applications for mortgages did not respond as well as the refinances. So obviously, with the rates that were low the past little while and now will go a bit lower, we look to see the refinance volume pick up again. Now, interesting though, the average loan size set a record for the third week in a row. The average loan size was $327,500 compared to the median house price, which is around $247,000, $249,000, somewhere in that area there. So you can see that the faster growth here is actually happening in mortgages in the higher price tiers. Now, whether that's new home purchases or existing home sales, we don't know, but the whole point though is that you can see that that's where the activity is. So again, people are looking to purchase, but the ones that maybe the affordable housing segment still haven't, I guess you could say, are convinced that they have opportunity or are not satisfied with what's going on in the marketplace right now. So that's a scoop with the Fed, and I just read today that the short term, I think 3-month and 10-year treasury bonds, I guess it's called the yield curve, I guess when they kind of converge and pass each other. So when it's actually, when there's better rates on the short term, I guess you could say interest rate component as opposed to a 10-year term, that's the inverted yield curve. That happened as well. And as I said, I'm not a financial analyst in this capacity at all, but from what I read and what everyone's stating is the fact that that's another typical sign that a recession is on the way, when those two rates and lines invert on the chart. So there you go. So you may want to investigate that a bit more. So big news that came out today, of course, from National Association of Realtors was the existing home sales from the month of February this year. So of course, everyone's saying the existing home sales has surged, and the home sales surged 11.8% positive, and this is a month-over-month comparison from January of 2019 to February of 2019. So in a 1-month span, sales surged 11.8%. And of course, the National Association of Realtors are attributing this to lower rates that were available in the marketplace, and also due to more inventory to choose from in the market. So now we see a little effect of some of the inventory coming on. But do not get too excited. And here's the thing I always want to caveat and make sure we're looking at this, is that this is a month-over-month change. And yeah, sometimes a month-over-month change can look great, but when you look at, February 2019 year over year compared to the previous 2018 February, sales were still down 1.8%. So which really indicates that January was not a good month whatsoever. So if we have if we're looking at 11.8%, almost 12% month-over-month surge in February, January wasn't that great because we're still down year over year in February. And again, because it was down 1.8% February year over year, this is 12 months in a row of sales volume declines. So we got a year's worth of less and less homes being sold every month. Median home prices were up 3.6% compared to last year. Median home price across the board is $249,500. And just to note, January's existing home sales numbers were revised down a bit. They came in at 1.2%, like negative 1.2%, and they actually revised to a negative 1.4%. So January was a little bit worse off than was originally indicated. Also, supply is still fairly low, 3.5 months of supply. That's up from 3.4 months of supply from January. So, even though we've seen more inventory coming on, we're sort of eking our way up in supplies. And again, as everyone says, what's a balanced marketplace? Most analysts suggest that 6 months is kind of an average where you've got equal number of buyers and sellers in the market. It is a normalized, healthy market in that capacity here. So when we go and look at the information that came out from NAR today, a couple of things I want to sort of take a look at here and just sort of go over with you. So for, this is percentages of who was buying, all right? Well, first-time home buyers, it was about 32% of the buyers were first-time home buyers. That's up from 29% from last year. 16% of home buyers were investors compared to 15% the previous year. And cash sales were actually down. 23% of purchases were from cash sales, whereas 24% were cash sales last year. And interesting to note, though, the distressed sales held even. So 4% of the market was distressed sales, and 4% of the market were distressed sales last year. So no change there. They did note, though, that now just for your information, distressed sales really are foreclosed homes, i.e. REO, which stands for real estate owned, which is inventory held, foreclosed inventory held by the lender, and short sales make up the distressed home marketplace there. And only 1% of the 4% were short sales. So again, short sales, having very little impact in the marketplace. And we've discussed this a bit, and people are inquiring, which is great, and I can talk more about it in the future. But that's kind of the hidden opportunity there, the hidden inventory that's not available unless you sort of dig for it and look for it and figure out how to get your hands on it. But again, 1% of the marketplace across the board is short sales, which is indicative on the local statistics I see here in my area and across the state of Florida where I live. Now, existing home sales by region. The Northeast was only at 13%, the West 21%, Midwest 23%, and the South was 43% of all those homes that sold in February. So big kicker there. Now this is interesting though. The percent change in sales from a year ago by price range. So everything is kind of broken off to 0 to 100K, 100 to 250K, 250 to 500K, 500 to 750, 750 to a million plus. All right. So the million plus home sales were down 6.4% as a percentage of the overall sales. The 750 to 1 million range was down 0.8% of all the home sales. 500,000 to 750 were up 2.9%. 250 to 500K were up 4.4%, which is a bit of a kicker there. That's good. 100 to 250K were 0%. There's no change. Same value last year as this year. And the real big loser was the 0 to 100K range, which was down negative 10.7%. So you can see that the whole, what I call affordable housing is really, for me, sub 250 marketplace here. And, the 100 to 250K had no change, so there was not an increase in opportunity or value whatsoever. And obviously the 0 to 100K, there's less and less inventory out there. So less sales in those two segments are indicative to the affordable housing crisis, the fact there's less homes out there, and that's where buyers need to be here. So again, great news for 1 month, but we're still in a downward trend in housing. This is kind of a brief respite, and by no means suggesting that this market is back to normal. You can't go and say, hey, this is, life is good now. There's no more housing bubble. There's no housing crisis that's going to happen in the future. Market's great. This is, and that's what people do. Is already they're saying this is very promising for a spring selling season or spring buying season. Things are going to be great. Everything is wonderful. So, that's still to be determined. There still will be more inventory coming on as we've seen. And, there's a lot of other things going on right now. So again, it's going to take some time to determine whether the rebound here was sustainable or mainly reflected a boost of pent-up demand from buyers who were still waiting on the sidelines that were waiting for more attractive mortgage rates that came early in the new year here. So that's a scoop there. Now, something that I think is very interesting that kind of goes in with what I'm saying here, kind of tags along, is that Realtor.com did a recent survey and found that over half the respondents that are looking to purchase a home are looking to purchase a home in the sub $200,000 range. All right, and as I just showed you here, that this is the segment or the demographic that actually has the least amount of inventory available. So the segment that needs the most opportunity is actually the segment that has the least inventory and is the most challenged. So what happens then, of course, they have to, if they still want to buy, well, two things, they continue to rent. So they keep on becoming or staying renters or become renters. And, if they do want to buy, they're going up into a next tier of pricing, which really means they're stretching their income. They're taking riskier loans. They're putting themselves in probably a riskier setup with respect to debt to income ratio and money out of pocket and things like that, low down payments, etc. So not the most ideal loan scenario, but they're being stretched if they have to go to that next tier in pricing. That's the place we're at right now. So with this survey, they found that affordability is still the main issue with most people. And, everyone's looking at this, as I said, this opportunity in the spring that we're going to see housing rebound, etc. Well, I don't think we're going to see housing rebound. And here's sort of proof of that. Basically, they stated that the spring buying season will be based on budget buying, budget expenditures. So we will not see the heated competition. You won't see multiple people vying for properties and pushing the prices up. Buyers are much more concerned about the economy now, and they're really looking at their expenditures and how far they're being stretched with respect to mortgage and house prices. So I guess this is almost like a potential sellers, people who want to put their properties on the market for the spring selling season, summer selling season. You are forewarned about this trend. I know I envision mainstream media saying everything's great, it's going to be wonderful. Things are wonderful for home buyers. Look for rebound in pricing and values, etc. I think we're going to see the opposite. We're being told here that the wave of buyers that's coming is looking for discounts. They're going to wait the market out. And if they don't really see what they like, they're not going to jump and bid for properties. They're going to be a lot more pragmatic about what they're doing. And I think that's really going to make the sellers have to perform to either allow concessions, price it much more effectively out of the gate, and offer some reductions along the way if your home is sitting. So again, as we segue from that to a comment called "The U.S. housing market hits a brick wall." So Redfin is out there, and Redfin the CEO of Redfin gets quoted quite a bit. Redfin is a brokerage house across the nation. They also buy and sell property, so they're involved in a lot of real estate, and they do a lot of research, which is interesting. Clearly, a lot of it is based on their own information, their own statistics, but other than that, they still add to, I think, the interest in the marketplace with some real decent information. They did a little research and found that that the U.S. housing market's kind of hit a brick wall. And what they did to determine this is they reviewed the February 2018 year-over-year growth, which was, of course, going from 2017 to 18. And that growth across the board was off the charts. I mean, that was one of the biggest gain months in a long time. So they took that February year-over-year growth, and they compared it to this February's year-over-year growth for all those markets, and this year-over-year growth was very weak. So they basically have stated that house price deceleration is staggering as far as they're concerned. So you've come off, this huge year-over-year, I guess you say price increase, and now you've got a year-over-year one which is not up here; it's actually gone down here, and we got this big delta. All right, that's kind of the issue that they're looking at, which I find was kind of interesting. And according to them, very few regions escaped a significant deceleration, with some prominent regions like San Jose and San Francisco even getting crushed on a year-on-year basis. So, when you had big-time gains and now we're down over here, that delta is huge. And a lot of the median prices in some of these mega cities and West Coast areas and whatever are actually they're way less than they were last year. So we have price reductions and value reductions. And their comment was the only thing that even comes close to this sharp deceleration they've seen was during 2007. So what happened in 2007? Well, that was just before we'll call it what's referred to as the Great Recession now, the global economic crisis, market crashing, and the housing bubble 1.0, housing bubble, gaining, bursting, and crashing and becoming a housing crisis. So I find this very interesting because now we have statistics and we can track data and we can look for trends and similarities, and that's what we're seeing right now. So this is yet another little sign that we're in the midst of the housing bubble bursting, and I think a lot of people still don't want to recognize that it's actually happening now. But when you start looking at stuff that happened back in the day 10 years ago, it's happening again. Maybe a couple little twists and nuances here, but when you hear things like this, like they're looking at the deceleration. I mean, we've never really talked about. We've always seen price appreciation. Now they're talking about price deceleration. So the swings are getting bigger now from your big time appreciation to now negative appreciation, which is depreciation. That delta is becoming bigger and it's starting to hit a little faster now. Now, an example of this, just again, we'll end off with this here, but you look at a city like Manhattan, okay, in New York City, Manhattan area. Well, Manhattan homes are staying on the market for the longest time in the past 7 years. So it's 2019, go back 7 years, we're in 2012. We're kind of at the kind of end of the housing crisis there, coming out of that phase. So properties are listed for a median time of 117 days before they go into contract. That's up from 90 days median from last year. Sellers ended up shaving 4.6% off their asking price. So it's taking longer to go into contract, and sellers are having to reduce the price, which would mean if you just reduce it at the beginning, and price it more effectively, then guess what? You're going to be into contract quicker and closing quicker. The market apparently right now is crowded with multiple choices. So if you're looking to purchase a place in Manhattan, now looks like the time. And home values were down 4.8% from February 2018. So that's another location where it had nice appreciation, and now we're down. So this bang, that we've got this going on here. Inventory is up 12% from last year, and the comments from some of the brokers there are the expectations are that inventory will also rise, and they expect record levels of inventory come the springtime. So here we are. So we're back in the situation where we see the signs. Things are happening. Are we as a society or as a general public listening to what's going on there? Are we looking at what's happening in the marketplace? Are we understanding it, or are we keeping our bubble mentality and kind of saying, it's not going to affect me. My property's going to sell, for more than my neighbor down the street, the neighbor up the road here, because I have an extra room, or I have a nicer lawn, or I have a carport or an extra garage, or I've got granite in my kitchen and they don't. I mean, when it comes down to it, if you want to make a killing on your home, you better price it effectively, because there's a lot more competition coming in the new year. I see it right now. I've seen locally our inventory increasing significantly, more properties on the marketplace, and we're going to see how that all kind of, I guess you could say, balances out as time goes on. So that's the scoop here. So that's it for today. So I want to hit these couple topics here, very important. So thank you once again for the views. I appreciate those. Thank you for the likes in the video and all your comments. So obviously, I try to respond to them as best as I can once the video is out. And again, please share the video if you'd like it. And also, if you are not a subscriber, please do me a favor and subscribe to my my channel, which would be most appreciated. And as always, if you want more real estate information or to talk about real estate investing opportunities or help with purchasing a home or just general questions, you can always email me directly. I'm engaging a lot of people now, so that's wonderful. And my email will be in the comment section or in the about section of our channel. And just hit me directly and we'll schedule time to talk, or I'll email you back what I can, information-wise, etc. So again, thank you very much. Have a great weekend, and we'll look forward to speaking with you early next week.